Talks, sponsored by Lexus of Las Vegas and Lexus of Henderson.
Well, March 9th, tomorrow, marks the 11th anniversary of the longest-running bull market in U.S. history. Local financial professional Brad Zucker from Safe Money Advisors joins us with what this milestone means for our finances. So, Brad, what does this mean?
Well, the importance of it is that the market bottomed out on March 9, 2009, but recently we've seen some events testing the current bull market run, anywhere from the U.S.-China trade war last year to the coronavirus's recent effect on the markets, sending Wall Street into a tizzy, only to bounce back to record levels for all three indexes. So the markets don't like uncertainty, and we do have some tips to help investors protect their money.
All right, so what are those tips?
Well, the first thing is you really should dial down on risk. The closer you get to retirement, the more important is to update your portfolio based on your age and how close you are to retirement. So we use what's called the rule of 100. You merely take your age, subtract it from 100. This will tell you how much should be at risk, like stocks, and how much should be at less risk investments, like bonds. So if you're age 30, 70% of your money should be at risk, maybe 30% less risk. However, if you're 60 years old, only 40% of your money should be in risk investments. So diversifying helps reduce risk and adds a layer of protection.
Right. So we're talking about how there's been a lot of fears, especially in the market recently, going down with the coronavirus fears as well. And a lot of people, they tend to buy or sell investment stocks rather, depending on how the market's going. So what would be your best advice for people?
Well, first you have to look at time horizon on your money. How close are you to your retirement age? Younger investors that could be working for 25 more years should not focus on short-term ups and downs in the market. But older investors that are about to retire may be wavering in their confidence if they don't have a written retirement strategy, because people that are in or near retirement should not have too much risk in their portfolios because they can't go back to work to replace the losses.
All right, so what else should people remember?
Well, really should be thinking long term, because emotions drive human behavior as well as investor decisions. We do get scared when the market drops, sell at a low. When the market goes up, we get greedy and we buy at a high. This is the opposite of effective market timing, because if you continue to make your contributions into your 401k when the market bottomed 2009, your account is up on average 466% by 2019. So a long-term view built into a retirement plan will help ride out these ups and downs and alleviate stress during these volatile times.
All right. So if there's one more thing that people should know, what should young investors and older investors remember?
I think that they should learn what you can and cannot control. We can plan and prepare for the ups and downs on Wall Street, but you cannot control it. But we can control other areas in finances, like how much debt we take on and what goes towards retirement savings. Unfortunately, more Americans are going into debt and less money go into the retirement savings. So if you want to know how much money you should have at this point for your retirement, you need to use a retirement calculator. And I've got one right on my website at askbradzucker.com to help crunch the numbers.
All right. Thank you so much again.
My pleasure.
We appreciate you joining us this
Absolutely.
morning. And we'll be right back after this break.